So given that we now know it's less to do with how often we win and how often we lose, but how we limit our losses, how then do we limit our losses? That's the next stage that I want to build up to. And that asks and begs the question, how do you find a stop loss? In order to explain that and show you the professional way in which we do this, before I show you the trading strategies that I and other professionals adopt so you can understand why they are the way they are, I need to first and foremost explain to you some basics. Okay? First of all, the bar that you see on screen, one method I use to find stop losses is what I call the average true range. What does that mean? Well, you look for any period of time at what the trading range is, and that's easy enough to find because you only need to look at the price chart. And it shows you this is the trading range. Now, that could be a 1-minute bar or a 5-minute or 15-minute or one-day bar, depending on your settings, and we'll go through that in a moment. So you find the initial fixed maximum stop loss. How? Well, first you need to find the average range that the security, whether it's dollars or the Dow, trades in. How do you do that? Well, we do it this way. We say the stop loss is going to be 2 times the average true range, fixed at entry. Because if it moves twice or more than twice the average true range, then it's not just market noise, it's actually a reversal. How do you find the ATR? Well, you can use an ATR indicator. Many pieces of software where they list their indicators will tell you what the average true range is and will calculate for you that on average, that's how much this range is. Maybe for the past 14 periods, I tend to use 14. It's a good number. 1 is too short, 100 is too much. So for the past 14 periods, it'll say the average that it tends to move up and down each day is so many points. And if you work out that your stop loss is 2 times that, then clearly that's not just general market movement, there's something more than that. So that's a good initial stop loss. But I'm going to show you a very clever trick we professional hedge fund managers and traders use. The initial fixed stop loss is then put at, as I said, 2 times ATR. Now, I showed you in previous module that you only risk a very small amount of your total risk capital. So if you lose any money, you lose a small amount and you've always got money to regain. And that way, you're always in the game. So let's say you set your initial stop loss at 2 times ATR, and you can do that roughly. You can estimate. It doesn't have to be scientific. It's just to make sure you don't get stopped out at a loss after you enter the market too close to your entry. So imagine this green arrow is the bar at which you entered, and this horizontal line is the actual entry point. And let's say 2 times your average true range means that your stop loss is here. So if the market falls to there, it's not just market noise, it's actually something bigger than that, so you exit. Your trade isn't going to work. Okay, that has to be 2% of your total risk capital. If it falls there, you lose 2% of your total risk capital. If you decide to move your stop loss further out, say 3 times your average true range, you're not going to lose more. Why? Because you're going to still say, well, that still has to be 2% of my risk capital. That's a very clever trick. What that means is you can reduce your risk by moving your stop loss further out. The great benefit of that is you're still not losing more money. You're less likely to be stopped out, but you're not going to lose any more money. See, what a lot of people do is they make the mistake of thinking, oh, I'll put my stop loss further out, but then I lose more money. No, you don't have to. You reduce your position size. It's your position size that's all important, not anything else. Got it? So let's look at that in detail. Let's say the average true range was 25 points, 25 pips. And therefore, 2 times average true range must therefore be 50 pips and 3 must be 75 pips. Simple maths. Okay? Now, assume your total risk capital is 100,000. Say $100,000 is what you have. 2% of $100,000 is $2,000. That has to be the same as 2 times average true range, which is 50 pips. Therefore, you must be risking $40 per pip. Simple, simple, simple math. Just look at that on screen. Pause it if you have to. It's very simple maths of what I've said. Equally, if you moved your stop loss further out, then 2% of 100,000 is still 2,000. 3 times ATR is 75 pips, so you must be trading $27 per pip. So if it falls further out, you only still lose 2,000 or 2% of 100K. Do you notice how you only change your position size? That's what mitigates your losses. Again, that then begs the question, why not always have your stop loss further out? Then you'll have fewer losses. Well, because only $27 per pip and not $40 per pip are betted or traded with, so you make less profit when you win. Do you see the trade-off? Yes, you'll lose the same amount if you're wrong, and you're less likely to be wrong if you have 3 times ATR further stop loss, but you'll make less money when you win. So your win-loss ratio will increase, but the amount you'll win will decrease. You see the subtle trade-off? All the simplicity of enter here, stop loss here becomes very complicated all of a sudden. But this is what professional traders do. They put their stop loss at a distance which avoids the loss, and they make sure that their downside is protected. I've told you one of the most important lessons of what professional hedge fund managers do and private investors don't. So which stop loss is better? Let's just compare them again. Let's say your average true range is 2. Well, the benefit is your total loss is fixed at 2%. That's the same benefit as with a 3 ATR. Your total loss is fixed at 2%. So the benefits are the same. What are the costs then? Well, the costs are you're stopped out more often of a potentially profitable trade than if you had 3 ATR. Overall, your win-loss ratio will be lower, but profitability higher on wins. If your ATR is 3, position size is smaller than if 2 ATR, so make less profit on profitable trades. That's the cost. But overall, your win-loss ratio is higher, but profits are lower on wins. So it all depends. Do you want to make more money, or do you want to be right more often? Now, most people in theory say, I want to make more money. But in practice, they want to be right more often. It's just how psychology works. People hate being wrong. They hate being wrong. And therefore, most people are better off having a 3 ATR stop loss than having a 2 ATR and making less profits, because they'll be happier. Now, let's look at, if you apply this methodology, what might your overall performance look? And I'll show you trading strategies where we do this. This is the building blocks to a successful trading strategy. Okay? Might seem a little bit slow getting to our trading strategy, but this is the building blocks to it. You need to understand this before you can actually get to trading professionally. What does it actually look like if you're trading professionally? This is the performance in the next slide of an actual hedge fund manager. This is Bill Lipschutz, who I interviewed for my book, Mind of a Trader, and this is the performance of his hedge fund. And this is what it might look like for good traders. Now, let me show you and explain to you what you're seeing on screen. On the horizontal axis, you see the number of months where he had a percentage loss. So if he had a loss of 0 to 1% or 1 to 2% or 2 to 3, that's on the horizontal axis. On the vertical axis, you see the number of months where he had a corresponding loss. So there were some, for instance, 40 odd months where his losses were between 1 to 2%. Got it? The losses were 1 to 2% in about 40 months. And what does this chart show you? If you do what a professional hedge fund manager, one of the most successful in the world, does, and the strategies, the money management, risk management that I've just taught you, and the strategies I'm going to teach you, this is what your outcome will look like. Notice there's lots of losses, but they are small. There's lots of small gains as well. Of course, everybody would like to have big wins and nothing else, but even the best traders in the world don't only have big wins. They have lots of small losses, lots of small gains. The biggest difference to success between you, a private investor, and a professional is that a professional will never have big losses, but they will have big wins. So when we look at our trading strategy, we need to make sure that as well as the stop losses, which we've discussed, which will protect us from having big losses, we have a methodology for making sure that we can run our profits and get some big wins. So how are we going to do that? That's what's in the next video.